Global stocks are down after a Walmart warning. Australia's unemployment rate ticks up, but jobs growth also surges. And the RBA says it's hard to see bad news in the Australian labour market. And China holds its key interest rates, keeping its powder dry so it can cut once the US trade war heats up. That's coming up in our 5 Things in 5 Minutes on Friday, February the 21st. And then in today's bonus deep dive interview, ANZ economist Vicky Xiao Zhou analysed more than 10,000 product classifications to understand the effects of 10% tariffs being placed on China by the United States.
In terms of the immediate impact in 2025, we expect a 5% decrease in export from China to the US.
But first, in 5 and 5 with ANZ, US stocks are down this morning, as are US bond yields and the US dollar, after Walmart warned consumer spending was weak. However, US jobless claims data out overnight suggests the labour market there remains robust, which would extend the Fed's rate-cutting pause into the second half of this year. Here's ANZ's head of G3 Economics, Brian Martin, to explain ANZ Research's change of call for Fed rate cuts, from previously 3 cuts over the next 6 months to those 3 cuts being delayed until the 6 months after September.
We think that sticky inflation early in 2025, a still strong labour market, and a lot of uncertainty around economic policy, in particular in relation to tariffs, means that the FOMC is going to take its time before resuming the rate-cutting actions. The expectation we have, though, is that the broad-based disinflation trend in the United States still remains in place.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.6%, with the US 10-year yield down 3 basis points to 4.49%. And the Dow, it was down 1.3%, the S&P 500 down 0.7%. The Aussie dollar was up, though, 0.9% at 64.00 US cents, and the Kiwi was up 1% at 57.65 US cents. Number 2, Australia's unemployment rate ticked up to 4.1% in January, while employment rose strongly by 44,000. ANZ economist Maddie Dunk says it worked out due to a record high participation rate as people entered the workforce, particularly women.
It was really a month for women. What we saw was that the participation rate for women was at a record high. The employment growth was really driven by females as well. So female employment grew 44,000 and employment itself grew 44,000. So it was driven by women, and female underemployment was also at its lowest level since February 2023 at 7.1%. So some signs that women are more active in the labour market.
Number 3, the RBA's Deputy Governor was quizzed about the data as people look for clues as to whether the labour market will allow the RBA to cut rates again.
Deputy Governor Hauser said that it's quite hard to see bad news in the labour market at the moment. And for the RBA, Hauser noted that the debate is more around whether the solid employment growth that we're seeing in the labour market leaves us with a bit less capacity or a bit more capacity. And if there's a bit more, then that might mean inflation is able to come down a bit more quickly than expected, and as such the RBA may be able to bring down rates more.
Number 4, China held its key 1- and 5-year loan prime rates unchanged yesterday, as expected. ANZ senior China strategist Zhou says the authorities don't want to ease policy too much in the near term. They want room to move if they need later.
We see the PBOC will delay the interest rate cut to the second half of this year. The US tariff risk has been delayed to Q2, but the uncertainty remains in place. We expect the PBOC will cut rate without hesitation if the growth momentum hit by tariffs. We maintain our call of 30 bips cut to the policy rate this year.
Number 5. Xiao says that for now, China's economy is doing better than it had last year, although with tariffs on the horizon, that could soon change.
China's economy is recovering well, both cyclically and structurally. Property price is stabilizing due to increasing demand boosted by the policy stimulus. Export benefits from the front-loading demand from the US due to the fear of tariffs in the future. The most important thing is the technological breakthrough in AI and robots.
Xiao there. Now, in our bonus deep dive interview, we keep the focus on China's economy. As ANZ economist Vicky Xiao explains how ANZ Research dug through 10,000 product classifications to be able to estimate that new 10% US tariffs on Chinese goods will contribute to exports to the US falling 20% over the next 4 years.
The additional 10% US tariff announced on the 1st of February lifted the effective tariff rate on imports from China to 23%. Based on our deep dive into more than 10,000 products classified under 8-digit HS code. Another important finding in our research is we found the shipments of tariff imported products increased by 15% in 2027. Followed by that, there was a 24% decrease in 2019, while the export of non-tariff impacted products remained flat. Similarly, we found some front-loading activities in the tariff impacted group in 2024. So following the pattern we've observed during the first trade war between China and the US, we expect a 5% export decrease in 2025 from China to US.
Just take us through what happened last time around. The tariffs were imposed and I guess trade dropped. Take us through some of the numbers and how that could be the same or different here.
So last time when Trump announced the first round of tariff was around mid-2018. But before that, he already kind of gave hint that he will impose tariff on China. So we've seen front-loading activities happening in 2017, which results into a 15% export increase from China to the US. And then after that, in 2019, we've seen a drastic decrease of 24% of export from China to the US. But if we took an average between 2017 and 2019, the actual impact on the export from China to the US is actually zero for the treatment group. But of course, following the 2019, there's a COVID noise because during the COVID period, there's a lot of exemptions on the tariff schemes, including medical products. So we performed analysis without the COVID noises, and we found between 2020 to 2023, the export between China to US dropped by 9% for the tariff impacted products. And then for the non-tariff imported products, the export increased by 6%. So overall, the impact sits around -4% for China's export to the US.
And I guess the expectation now is that these new tariffs will reduce the trade deficit between the US and China.
So first of all, the impact of 10% additional tariff to China's GDP, it is around 0.5 percentage point over the next 4 years. And then in terms of the immediate impact in 2025, we expect a 5% decrease in export from China to the US. And overall, the impact to China's export will sit around 0.6%. It's very difficult to say what's the impact on the deficit at the current stage, but what we can see is the trade frequency is going to drop between China and the US. Currently, the 10% of tariff is slightly positive news for China compared to the 60% tariff what Trump claimed initially, but we remain cautious on the US policy to China at this stage. And then there could be more news coming up in the next few weeks. And then there was a news that US is going to impose more tariff on automobile, pharmaceutical, and chips, etc., certain products. This more tariff will definitely impact China's key industries like EV sectors.
So run us through, given the new announcements, what these industries sort of mean to China's economy and what's happened recently.
There's one sector we pay close attention to is the pharmaceutical industry. We've observed that the export of pharmaceutical products from China to US increased significantly for the past few years. And the newly announced possible tariff on China's pharmaceutical products will definitely impact China's key sectors.
Vicky Xiao there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, February the 21st. Catch you next week with Australia's January inflation data and key New Zealand confidence readings. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.